Talk about what you see for the next 12 months.
Well, for the next 12 months, I think the market is in pretty good shape. It is not overvalued at these interest rates, so I think it still has room to go higher.
Journal today argues that the new normal, maybe 19 and a half times is the new normal. What do you think that number really should be?
Well, I think the market could sell at 20 times. Remember, stocks are related to interest rates. They compete with bonds, and with rates below 2%, a 20 multiple could certainly be supported.
Rates seem to be the most important thing. I don't want to put words in your mouth, Byron, but I've been listening to you for a long time. I mean, am I right?
Yeah, interest rates are key. I mean, the geopolitical background is important too, but even that has been cleared up. We now have a phase one deal for China. Brexit has been resolved, or looks like it's going to be resolved. So, some of the clouds that were hanging over the market are no longer there, or at least they're not as dense as they were before.
So if you're reassured about a China trade deal, what are some of the biggest risks you see facing the market next year?
Well, we could have a rise in inflation that would drive interest rates up and would drive multiples down. It would create risk in the market. We could have an election outcome in the market that would affect the market negatively, having one of the more progressive candidates get the nomination and actually win. But right now, I don't see any severe thunderstorms afflicting the market in 2020.
Byron, I always ask you this, try to characterize your concerns about deficits and the debt. You got an economy growing at 2, you got debt growing at 5. I mean, it's not a U.S. phenomenon, it's a global phenomenon. We had Greenspan on the other day who said, given deficits, inflation will inevitably rise, and he's had this stagflationary thesis for a while. When do you get concerned?
Well, nobody knows what that point is. One thing I've said, I think I've said on the program, Carl, is in the year 2000, the accumulated debt of the United States was $6 trillion, and the blended interest rate was 6%. So the debt service was $360. Now the debt is $22 trillion. The blended interest rate is a little over 2. The debt service is $450. So the debt is almost quadrupled, and the debt service has only gone up 25%. That can't go on forever. So eventually interest rates will rise, and that will create serious problems for the market. But I don't think that's a problem for the next year.
Byron, it's a great stat, and I remembered it from the last time when you said it. Only a $90 billion increase in our interest costs. But what it makes me think is we can't have interest rates go up. It's simply not a sustainable thing in any way for the U.S. budget for rates to go appreciably higher, because we'll be completely sunk in terms of interest payments and how much of the budget that takes up.
Well, I want you to get a good night's sleep on Christmas Eve, Carl. So let me take some of the...
That was me.
Oh, I'm sorry. I didn't realize that. So the point is that there's so much liquidity out there. In 2008, the central banks had about $3 trillion on their balance sheets. Now they have over $16 trillion. So there's a lot of liquidity out there looking for a place to hide. And that liquidity keeps interest rates down. So I don't think this is a clear and present danger. I think rates will stay low during 2020. But you're right to be concerned. At some point out there, rates are going to rise. And both the bond market and the stock market are going to have a tough time with that.
Byron, we've been looking through your predictions for 2019. Most of them turned out to be very accurate. One of them was that growth stocks would continue to provide leadership with technology and biotech doing well. We certainly saw tech stocks have a banner year. I know you don't officially give your predictions until January, but can you give a hint about some of those sectors, particularly tech, after such significant gains this year?
Well, Julia, I've always been a growth stock investor. I'm a believer in it. I don't think earnings for the S&P are going to be up a lot next year, maybe 5%. And if that's the case, if you can find a growth stock with earnings up 15 to 25% at a reasonable multiple, I think that's attractive.
Byron, politics, come January, we're going to be focusing on Des Moines and New Hampshire. It feels like the market always does a little too much hand-wringing relative to the actual threat of policy, given all the things that would have to go right for things to be implemented after November. How do you think that's going to feel, come Super Tuesday?
Well, look, Donald Trump is going to be in a trial relative to his impeachment. I don't think he'll be convicted. So he'll be the candidate for the Republican Party. I don't know who the candidate for the Democrats is going to be. But right now, I would have to say that Trump will be reelected because I don't see a Democrat candidate who can beat him. And so that means more of the same for the market. So the market is assuming there isn't going to be a serious political change in the United States. And that's why it's continuing to rise.
Certainly explains a lot of the action over the last several weeks.